Ladies and gentlemen, welcome to our latest edition of our Basel IV channel. Yeah, the 7th of December was the big day. There was a press conference of the Basel Committee where they proposed the new Basel IV framework. We were waiting almost 2 years for the finalization of the... Hey, Stefan,
you're
how are you?
talking about the G-House meeting yesterday.
Yes, of course.
What's the big news?
The big news. Of course, one of the most controversial discussed topics is, of course, the output floor. And after almost 2 years of discussion between the supervisors, there was a quite big little argue between the American supervisors and the European supervisors, what would be the best calibration of the output floor. The American supervisors were more for a quite high capital floor, which was at least 80%, while the European supervisors preferred more a lower one, like around 60% or 65%. Yeah, and finally, on the 7th of December, they agreed on an output floor of 72.5%.
But that's not the only thing they mentioned at the meeting yesterday. There is also important changes to the standardized approach for credit risk, IRB approach, the CVA risk charge, and of course the standardized approach for operational risk.
Yes, absolutely. When we only look to the standardized approach for credit risk, there are some material changes, especially for the exposure class of banks and corporates. There's a recalibration of the use of external ratings. There's a new treatment of unrated positions. When we look to real estate exposures, they switched to a more risk-sensitive LTV approach. There are new risk weights for the new exposure class of specialized lending, new risk weights also for equity exposure. So there are really material changes also in the other parts of Basel IV.
And the same is true for the IRB approach as well. We have important news with the application of IRB to banks, to large corporates, or to equity portfolios and specialized lendings. We have new approaches for the calculation of the CVA risk charge, and we have a very, very much advanced standardized approach for the calculation of operational risk capital charges.
Yeah, so there are really a lot of topics, therefore we decided to use the possibility and record a special edition of our Basel IV channel that is concentrating on the latest developments and regarding the press conference on the 7th of December. But because the impact might be quite big, I think we should start with a quick look on how Basel IV might impact the risk-weighted assets of European banks. So welcome to the Basel IV channel and enjoy.
Thank you, Martin. It's indeed a pleasure to speak about the finalization of Basel IV, and of course, as still regulators or some regulators refer to it as the Basel III reforms. Quickly, for those that don't know me, Abdellah M, working in the Netherlands, responsible for Basel IV in the Netherlands, and the Deputy Global Basel IV leader. And indeed, Stefan is also part of this important channel. Stefan, can you introduce yourselves?
Yes, sure. My name is Stefan Röth. I'm working for PwC here in Germany, and I am the leader of the Standardized Approaches Workstream here in Germany, part of our global Basel IV initiative.
Right, thanks, Stefan, for also being here. So I think if we move forward and look at perhaps the agenda for today and what we will be covering, since Basel IV on the 7th of December has been finalized and the G-House has basically presented its outcome in the press release and the basically meeting with Mr. Draghi explaining the outcomes and the final secrets in there. As you all know, the most important topics that were open were the credit risk standardized approach, the internal ratings-based approach for credit risk, CVA was also not finalized, and then as well the operational risk, where we obviously already knew that the advanced measurement approach would disappear. And there was already a draft from the Basel Committee around the new approach, the standardized measurement approach, but that was not finalized yet. So that's also finalized, and of course, in the end, most important thing is around when all this comes into force. The whole package will come into force January 2022, meaning that also the parts that have already been finalized, particularly the FRTB, will by default be postponed. Then there is also the capital floor, which we will also be discussing, and was actually the main and most important, or I have to say the most important part that was still outstanding, especially the level of the capital floor, which will be phased in starting 2022 through 27. So on the overall the credit risk standardized approach, finalization of the recalibrated risk weights for a number of exposures, especially the, let's say, new exposure class specialized lending, but also the treatment of real estate, both commercial and residential, because there were also quite some discussion, especially around the impact that it had for a number of countries in the mortgage portfolio. Then the IRB approaches, the paper around the constraints of the IRB was actually quite severe, limiting the IRB approach for a number of exposure classes. Basically, the final standards are back to allowing more in terms of advanced IRB for, let's say, the non-larger corporates, also specialized lending, which was actually abandoned in the first proposals, and then still foundation IRB with own estimation of PDs for banks, large corporates. For equity exposures, the use of the IRB approach, where the foundation IRB is completely disappeared. Then finalization of the CVA approach, part of, or in two parts, the standardized approach and the basic approach, where the standardized approach is basically aligned with the FRTB approach, with basically also the sensitivity that are applied in the standardized approach for FRTB alignment, and so that's also finalized by the 7th of December. And then operational risk, basically the bucketing of the revenues and losses, so taking the financial statements or the P&L as a basis, and then dividing in buckets and multiplying by the loss multiplier, which looks at the historical losses, but we'll get into more details about that later on. So maybe a quick step back in the Basel history, which sometimes is interesting to look at the history. Interestingly, I think one of the first proposals for Basel was actually 30 years ago in December 2020 or 1987. So before the final accord in 88, and then as you see along the basically history and the evolution of Basel, the Basel framework, particularly on the focus here, of course, on Pillar 1, where credit, market, operational risk is basically scoped in terms of capital requirements, and basically it would all along or in response to crises would basically develop new standards in response to certain crises. So we've seen, of course, with the recent financial crisis or 2008, where liquidity was quite an important risk, resulting in a number of banking failures. So as part of Basel III, liquidity was covered, and the leverage ratio was also added to Basel III. So over time, it developed significantly, taking more and more into account in regulating under Pillar 1, setting capital, liquidity, and leverage requirements. On the right side, we see basically the most important Pillar 1 ratios, being basically the capital ratio, and of course the main one is the Common Equity Tier 1. That's why we depicted Common Equity Tier 1 over RWAs. Of course, total the total capital ratios, including AT1 and Tier 2 capital. And then in addition, the capital ratios, the, let's say, shorter stress type of ratio, the liquidity coverage ratio, which basically looks the total high-quality liquid assets, liquidity buffer over net cash outflows over the next 30 days. And then the more longer-term stable ratio, the net stable funding ratio, which basically looks at the stable funding and then sets out against the required stable funding on the asset side. So that's liquidity, and then introduced under Pillar 3 the leverage ratio, which is also under the finalized Basel IV or reforms of Basel III, a bit adjusted to count for a, let's say, higher leverage ratio or an add-on for global systemic important banks. And then, of course, last but not least is the large exposures, capping basically the level of exposure to a single counterparty. Basically, overall, how the Basel, particularly Pillar 1, has developed over time, and where we stand now with the finalization of Basel IV, with the key topics mentioned before, and some other topics that were already finalized before, which we will also briefly cover later on. Then, I think moving forward in terms of what is actually Basel IV, or what we consider Basel IV. So under Basel III, with a quick step back, so let's say the actual Basel III without the reforms, the key focus known in Europe as the capital requirements regulation was around the, let's say, the own fund side, or the capital side, so higher buffer requirements, stricter definition to increase equality, increase of deductions, and so on and so forth. Focused on basically three elements: common equity tier 1, additional tier 1 capital, and tier 2 capital, with a predominant focus on common equity tier 1 capital. So the other side, basically the RWAs, let's say generally for credit, market, operational risk, was not really changed under Basel III. Of course, there have been some updates, and of course inclusion of CVA, and on the credit risk side also in terms of central clearing party. So there have been some changes, but those were limited compared to the work that was on the capital or own fund side. So with Basel IV, it basically looks at the RWA side, and it changes completely all approaches and for all risks, meaning that obviously one would expect a significant impact. And with significant, it could either be, let's say, in amount, in terms of RWA and hence the capital ratio, but also in the level of effort, which basically means that a lot of work has to be performed to implement and adjust to the new requirements. In terms of the individual impact on banks, in terms of, let's say, the ratio and the capital requirement, it really depends on the business model, and of course the risk of the assets when looked at the, let's say, credit risk side. Also the level of trading, whether internal models are used, and so on and so forth. So it's really dependent on the business model, and we've seen through a number of impact assessments that we have performed that it really depends on the type of bank. And of course, we'll provide an overall overview of the impact, but generally it's really a bank by bank type of assessment and conclusion. Then, and of course, it's also important in terms of response, basically the level, or let's say the room or the ability of a bank to respond to the increased capital requirements by either increasing, let's say, pricing and being able to absorb the increased capital requirements. Of course, if there is significant competition, that would be quite a hard journey, obviously. Then the second effect, where basically we distinguish between individual impacts, but also basically related effects in terms of other market participants that could be affected either positively or adversely, the reforms, the Basel IV changes, especially on higher capital requirements for certain assets or other market players, whether they are pension funds or insurance companies coming into play. On the other side, of course, counterparties of banks in, let's say, from the financial markets side, in terms of trades with these parties, could also be affected, where they will see potentially higher prices or other structuring of trades with these other market participants. So it really is an individual bank type of impact, as well as a more market-wide type of impact, which has to be taken into account. Then if we flip forward and look at, let's say, the numbers, and we're looking, it's important to say, I think here we're looking, of course, at Europe. So for, let's say, professionals or others that are watching this from other territories outside Europe, please, sorry for focusing only on Europe here. But if we look at the countries in Europe and look at the impact, and it includes the largest banks in Europe in this assessment, you will see a significant increase overall in terms of RWA, up to basically 22%, equivalent of 2.5 trillion in RWAs. Of course, it's important to add here a number of aspects, since you've all probably also understood on the 7th of December when the results were presented that overall, basically the Basel Committee had presented even, let's say, a flattening or lower, or let's say an increase in CET1. So there are banks that are positively affected. So importantly is here that it's only the largest banks. It's of course only Europe. So it's not, let's say, apples with apples that are compared. So if we look at the countries that are significantly affected, are the top three countries: Sweden, so the Nordics, and then the Netherlands, and also Germany is significantly affected. And of course, the question is what drives the effect. Of course, generally, is the riskiness or of let's say the asset, because the effect is mainly, as you can see, or the significant effect is on the credit risk side, which is of course driven by the standardized approach and the floor, which we will discuss later on. So basically, the riskiness, but also the level of use of internal models. For example, in the Netherlands, the larger banks are one of the basically top banks in terms of internal models usage. So the more internal models that are used, basically the potential higher impact to the floor. In addition, of course, which goes for, I think, Sweden, Netherlands, the effect through the floor on residential real estate, so mortgage loans, which are significantly affected, generally have, using internal models, low risk weights, and then with the application of the floor, the risk weight will increase, and hence the RWA will significantly increase. So this is basically in terms of overall impact, and again here important to add and to say again that it's really a bank by bank type of assessment to really understand what the impact is and not take this as directly applicable to your bank. So most important, of course, Stefan will cover later on the next steps in terms of really making sure you do the impact assessment as soon as possible. For two reasons. Of course, you have longer dated type of assets, so you have to take into account any impact on those, impact on the business model, which you have to already take into account, even though the phase-in period is over a longer period. And in addition, there will be, of course, basically stakeholders expecting some numbers, and banks will be forced to start sharing with the public the potential effect of Basel IV. So that will also put some pressure on other institutions to do the same. So moving forward to basically going to the finalized papers or standards. First of all, and I think this was one of the most important points that everyone has been waiting for, is around the capital floor. the output floor for those that are in the terminology. It's basically, of course, we all knew there would be a floor, and the floor would be calculated, or the basis for the floor would be the standardized approach, the revised standardized approaches, but the level was not communicated. So the final level is 72.5%, which is basically taking the RWA under the standardized approach, so all risk types, including exposure types, under the standardized approach, and then multiplied by 72.5%, and then that is compared to basically the RWAs using the bank's internal models. And basically, the higher of the two is the RWA that drives the capital requirement that the bank has to take into account. So even though the 72.5% is set, it will be phased in over a period of 5-6 years, 2022 and then 2027, with the final basically 72.5%. So all in all, it's perhaps slightly lower than the, let's say, 75 or even higher percentage that was that some were calculating with. In addition, the floor is calculated on an overall basis, so not by risk type or even portfolio type. So that gives some basically, let's say, compensation effects where the bank is using, for example, the operational risk where only a standardized approach is being used, and for let's say exposure classes where no IRB is used. So then, in terms of, let's say, the other aspects, so this is a floor which is being phased in, but the other aspects, these all start January 2020. So basically, this will be one big bang in terms of implementation. Then, in addition, the leverage ratio, which will basically be also starting January 2022, and an add-on for GSIB or a GSIB buffer, which basically is 50% of the GSIB buffer for the specific institution. So there we will see a bit of a higher leverage ratio compared to the other institutions. And going so with the floor and the coming into force of the, let's say, specific standards and the leverage ratio, we move forward to go into a bit of more detail of the, let's say, risk finalized papers, and looking at the credit risk standardized approach. Now, this is quite a full, let's say, a page, but basically there have been also, compared to the previous proposals, a couple of changes. So if we look at the different exposure types, there is an important change in terms of for banks that are basically either or institutions that are either not allowed to use external ratings for risk weighting, or where the basically customer, in case it's a bank or an institution, is not externally rated, to basically bucket in the three buckets A, B, C. Basically, what happens is the lowering of the risk weight and adding a, let's say, an A+ bucket, which is driven by the CET1 ratio and high leverage ratio for this specific institution, where then you're allowed to use the 30%, which dampens a bit the effect for, let's say, banks that are using now the risk weight based on the sovereign risk weighting, where basically 20% is used for countries where the bank is established and the country is assigned a 0% risk weight, or triple A, double A, and then would assign 20% for the specific bank. So there is some change there in terms of institution. There may be an important one also in terms of the effect, and the change relates to specialized lending and real estate. So in specialized lending, there has been, let's say, a lowering of the risk weight in terms of pre-operational project finance, but also there has been for project finance that are basically in operation, a potential for a low risk weight of 80%. These are kind of high quality project finance where the counterparty has sufficient means to meet its financial obligations or related to government and so on and so forth. So there are a number of requirements to be met to classify for the 80% risk weight, which it dampens a bit the effect. Then in terms of real estate, which is both for commercial and residential real estate, an important change is the so-called credit splitting, which exists currently under the CRR, where basically you could split an exposure into a part that would then be commercial real estate or secured by commercial real estate or residential real estate, and then apply a lower risk weight for. So, for example, residential real estate, you basically take the property value and then 55% of that property value. The outcome of that would then be risk weighted against 20%, and then the remainder of the loan, so the loan minus 55% multiplied by the property value, would then be basically risk weighted in accordance with the counterparty. So where it's a retail counterparty would then be risk weighted against 75%. This goes also for basically for commercial real estate, of course, with high risk weights, but also for commercial real estate, the use of the credit splitting is allowed, which gives a bit of, let's say, leeway for especially the IRB banks, which are significantly affected by the floor in these portfolios. Quickly, some other changes. So look at retail, so-called sectors revolving credits, where you basically fully pay the exposure at the next payment date. There you would apply a 45% risk weight, and some other changes where the commitments are particularly impacted, where there will be, even for unconditionally cancelable commitments, a minimum of 10% credit conversion factor, and for other commitments, 40%, and that is a, let's say, kind of a tricky impact where currently there is a split between, let's say, 1 year commitments and commitments beyond 1 year, where there is a 20% and then 40% credit conversion factors. That's all basically 40%. So for the shorter term, so the 1 year, below 1 year commitments, there we will see a higher credit conversion factor, and then obviously you will see a higher capital requirement. So all in all, finalized credit risk standardized approach. There are basically some, compared to the previous proposals, some improvements. I mean, by improvement, some, let's say, lowering of risk weights, whether it's in the institution side or on the, let's say, real estate side. But of course, then on some of the other changes in commitments, it's basically adversely impacting. But again, it's still bank-on-bank assessment, and the, let's say, IRB banks will still be significantly affected by, or most likely significantly affected by this standardized approach for credit risk through the floor. So by that, I would like to hand over to Stefan to continue the remainder of this presentation.
Thank you, Abdellah. And we turn our attention now to the IRB approach and take a look at the changes presented here. And as Abdellah already said in the introduction, the main message has been that the applicability of the IRB approach is not limited in that very strict way that was proposed by the consultation paper. Instead, the IRB approach will still be allowed for all exposure classes, with the single exception of equity exposures, where, to be honest, it was maybe a bit misplaced from the beginning. However, as I just said, for all other exposure classes, the IRB approach remains applicable. However, for some exposure classes, it will be limited to the foundation IRB approach. So, for example, banks, other financial institutions, or large corporates, there only the foundation IRB will be applicable, not the advanced IRB approach. That remains an option, of course, for the retail portfolio, for the small and medium-sized enterprises, but also in the case of specialized lending. So as you can see here, also the discussions about removing the IRB option for specialized lending cannot be found in the final Basel IV paper. And we are losing a friend that has walked the way with us for a lot of years, the famous IRB scaling factor of 1.06 that was applied to the risk weighting formula. Unfortunately, will not survive Basel IV, but will be deleted. On the other changes, we can see that the floors for PDs and LGDs are changed in some way or other in order to make the calculations more conservative and also maybe more transparent. And the same goes for the estimation of parameters, where there is a range of new requirements to make sure that parameter estimation is done in a consistent way by all banks using the IRB approach. Now, if we look at the next slide, here we have the news with regard to the credit valuation adjustment risk, and well, basically not a big surprise. There is only two approaches left. So the FRTB internal model-based approach also is no longer part of the final Basel IV rules. This has already been hinted on as part of the BCBS 362 that was published on Easter 2016. So among the two remaining approaches, we have a standardized CVA approach that is also based on the fundamental review of the trading book, trying to estimate a CVA based on the sensitivity towards a counterparty's credit spread. Main changes here, or the important news here, are that banks will need some way of supervisory recognition of this approach before they may use it, and also that the calculation of the EAD can be based on accounting values, so does not require an internal model method for counterparty risk. The second alternative, the basic CVA, well, there still is this huge formula. However, compared to the consultation papers, we've seen quite lower risk rates, and we can also see quite lower exposures at defaults, mainly through the introduction of a discounting factor, which, well, basically is a reaction to the criticism that the industry has voiced that the basic CVA is calibrated in a very, very conservative way, especially with regard to long-running derivatives. And finally, there is a sort of fallback approach for those banks not willing or able to calculate the CVA, and this fallback approach simply asks banks to use double the counterparty credit risk capital requirements instead of performing a CVA calculation. And this is quite interesting because if you look into the current CRR, you can find a similar fallback there, which says that you have to take 10 times the counterparty credit risk capital requirements. So it would be a quite tremendous change if it's not longer 10 times but only twice the CRR capital charge. Then looking at the topic of operational risk, this is no longer called the standardized measurement approach, but simply the standardized approach for operational risk. Still, the basic structure of the standardized measurement approach can still be seen. So we still have a business indicator consisting of interest, lease, and dividend component, service component, and financial component. But you can see that the formulas used to calculate these three components are much simpler than before, though there is no longer so many maximum, minimum, and whatever functions involved. And what is new is that the BI component is used to allocate banks into 3 buckets instead of the 5 buckets that we've seen in the consultation paper. And what is also new is that there is a marginal coefficient by bucket. The numbers 12%, 15%, and 18% may sound familiar to everyone familiar with the topic of operational risk. And as before, there is an internal loss multiplier that will be applied to buckets number 2 and 3 to adjust the capital requirements based on historical op risk losses. Now, this has been the news of the Basel Committee. However, do not forget there is a number of other papers that are usually summarized under the heading of Basel IV and that have been published and finalized before 2017. And for those of you in the European Union, these papers are already on their way to being implemented as part of the CRR2. So, for example, the fundamental review of the trading book or the new standardized approach for counterparty credit risk, and most importantly, of course, the revisions to the securitization framework, which are going to enter into force in the European Union at the beginning of 2019. So, what does all of this mean? Well, basically, it means that now we have certainty on how the Basel Committee wants these new rules to look alike. So we don't have to guess any longer. We can look into the final Basel IV papers and find out how risk-weighted assets will be calculated in the future, and therefore it is very important, as Abdellah already said, that we use this opportunity now to perform impact studies and find out how Basel IV impacts a specific bank, a specific portfolio, a specific type of assets. If you think back to the introductory slides, there we gave you some rough numbers that RWA increases may be somewhere between 13 and 22%. Now, of course, you can say that's a bit like being caught between a rock and a hard place, but still it makes quite a difference if it's rather 10% or more in the area of 20%. So you should find out now how the revised approaches, not only those that have been introduced at the beginning of December, but also the other papers that I just mentioned, would impact a bank in order to being able to have adequate measures in place. So even the year 2022 may look like a long time away. Well, every position that you enter into now with a maturity of 5 years or more will be caught by these new rules, and therefore you should be very well able to have at least a rather good estimate of how they will impact your risk-weighted assets. Summarizing everything that we have learned today, there is a number of quite remarkable challenges for the banking sector, and this starts with the fact that you have to analyze your business model, your risk strategy and business strategy to find out how it is impacted by Basel IV and take adequate measures, as I just said. Also, when we look to the revised standardized approaches, all of them are quite complex, quite data intensive. So banks will really see a number of challenges implementing these so-called standardized approaches. When we look to the internal models, you've had some luck, obviously, that the IRB approach is not completely off the table, that it is still applicable to a number of exposure classes. However, there is the capital floors, and they won't go away. They are here to stay, and they, of course, make it much less favorable to use internal models than before. Or to put it in another way, if you really want to lower your capital requirements, don't optimize your internal models, optimize the way you implement the standardized approaches, because they are what counts when it comes to determining the capital floor and therefore the level of risk-weighted assets. And as I just said, even though there is a few years left until 2022, you should start now, because you can be sure your competitors will already be analyzing all of these rules, trying to gain an edge, and therefore you should start test calculations or impact studies right away at the beginning of next year in order to be able to deal with these new rules now that we have, as I just said, transparency on how they will look like. And this has been it, our special Christmas edition of the Basel IV Channel. Thanks a lot for being here together with us and joining in this webcast. And we wish you all a Merry Christmas and hope to talk to you again next year.
Thank you very much, Abdellah. Thank you very much, Stefan. It was again a great presentation, and it shows again how big and complicated the topic of Basel IV is and how challenging it is for our clients. And that brings me to one important point that I would like to mention again, because Basel IV is not only about sending regulatory reports to your supervisors, it's much, much more. Basel IV has a lot of strategic implications, and these strategic implications highly depend on the business model of each bank, the risk appetite, what the portfolio structure of banks, and also in which kind of environment the bank is. Is it a high interest rate environment? Is it a low interest rate environment? And also the extent of the use of internal models is very, very important. And we would like to support you on these challenges. Together with our strategy and team, we can analyze all these strategic implications and support you in the preparation on these strategic challenges. But before we can actually analyze these strategic challenges, it's very important to perform an impact analysis. And we as PwC, we can provide you with the perfect tools to perform these kind of impact analysis. We have for all the new standardized approaches, no matter if it's for credit risk, market risk, operational risk, we have the right tools for that to support you in analyzing and calculating it. Also in the analysis on the implications on the business departments, like on the treasury department, trading department, or even on the credit department, we can support you. And what we also should not forget, Basel IV has a lot of IT implications. No matter if we are talking about the new standardized approach for credit risk, for market risk, or for operational risk, a lot of new data is needed, a high data quality is needed, and that brings me also to one very important point. Right now it's the best moment to think about the IT infrastructure for your regulatory reporting. A lot of banks already think right now about changing these infrastructure, moving, for example, to a more standardized regulatory reporting software, or moving from a standardized software to a more individual one. And we, of course, can also support you on that. Last but not least, Basel IV is very complicated, so your staff needs to be taught on it, and we as PwC, we provide you with a huge training program for all different kinds of levels, starting from the C level until the trainees, with the right training courses to show you how the topic Basel IV is actually working. Yeah, that's it for today. Thank you again for watching this Basel IV Channel episode. I would like to thank you all for watching this episode, and also thank you for your loyalty, because you are watching for almost 2 years this Basel IV Channel, and we are quite successful on this. So this brings me really to the last point I would like to say today, and that is that I wish you all a Merry Christmas and a Happy New Year, and I hope that you find the time between the festive days to relax a lot, because that's definitely something that I will do, and I will start directly now. So bye bye, Merry Christmas, have a Happy New Year. Bye.